Garrett-Cox, CEO of Alliance Trust. Katherine.
Thank you very much indeed, Fiona, for that very warm welcome, and welcome back after lunch. I think it's always a bit of a tough gig to follow the Mayor of London, but we'll do our very best, and we have assembled a very lively and global panel to discuss how the UK maintains its competitiveness on the asset management stage. So by way of introduction, in terms of the global and international people we have here today, I'm delighted to introduce Tidjane Thiam, Group Chief Executive of Prudential PLC, Dominique, Carrel-Billiard, Chief Executive of Assett Investment Managers Group, and Davide, Serra, Founder and Chief Executive of Algebris Investments. So with that, I'm going to sit down so we can keep it quite lively. And I think that in terms of getting the discussion going, as Fiona said, we heard from the Prime Minister this morning that we have to play to our strengths. And I think we have fantastic strengths here within the UK, both in terms of a place to invest in and as a place to invest from. So I'd really like to turn to each of you in turn for a few brief remarks as to how you think the UK can maintain its competitive edge. So Tidjane.
All right, thank you, Katherine, and good afternoon. You've asked us to be lively, so we will do our best for the courageous souls who turned up after lunch. So let's start. Maybe a few words on the insurance industry. We are a very large long-term investor, of course. I think we have 18% of the UK gilt market, 13% of the shares of the equity market, and absolutely, because of the nature of our liabilities, a natural long-term investor. Of course, the UK is a very prime destination for our investments. I think that since 2004, the UK has attracted 1 in 5 of all investment announcements in Europe. So the UK is starting from a good place. But that's all the past. And as you said, the question is going forward, what should we focus on? And I'll just mention 4 or 5 headline points, and I think we will come back to that during the discussion. But the first one, it's been mentioned this morning, is really stability and predictability. You cannot invest in the dark, and you need to be able to have reasonable expectations, and you need for those expectations to materialize, particularly over the long term, if you're looking at 20 or 30 years. And I think we cannot say this enough, but the rule of law is a very, very important factor in that equation. I once had the misfortune of trying to attract FDI to a small West African nation, and an investor asked me once, he said, look, I only invest in countries where I genuinely believe that if I sue the president's son, I have a chance to win. Okay? So I think my country didn't meet that test. So as the Prime Minister said this morning, in the UK, you have that, and that's an enormous advantage. I think the second point is really risk-reward. That's how I would characterize it. There has to be a reasonable risk-reward balance, i.e. you have to be able to make money at the end of the day. You invest for a profit, and I think that there should be no stigma attached to remuneration and profit when it provides the incentives that drive positive long-term returns, which are a very good thing for the economy. On the downside, there is risk, and that's probably where government has a big role to play, because you invest for the long term. You understand that the world is random and bad things will happen. What matters is the mindset of the authorities when that happens, and how, if you wish, your initial conditions on which you base your initial decisions can be respected, and how shocks or incidents can be mitigated. That is really, really very important. A lot of countries focus on sheer attractiveness. I think experience shows that actually your ability to withstand shocks and how you manage through the economic cycle is a much more important factor at a point in time position or situation. I think the next thing I'd like to talk about, and it's been mentioned this morning and very sensitive for us, we are a regulated sector, is to have the right kind of regulation. And I'd say 3 things about regulation. It has to be fair, it has to be transparent, and it has to be predictable. And those 3 characteristics matter very much. And unfortunately, in our sector, we've been exposed to a relatively unfortunate experience with Solvency II, which for me is a case study in how not to do regulation. Because the first thing I'd say about it is it's been going on for 11 years. The second I'll say about it is that it's a big bang approach whose ambition it is to establish one single regime for 27 countries starting from completely heterogeneous positions and to get there in one go. I think that has proven, I won't say an elusive goal, but let's say very difficult to achieve, and we have spent, I think the regulator himself, Andrew Bailey, said the costs were indefensible. And these are costs that have been imposed on us, and in the end they are paid, and that's a point I want to emphasize, they're paid by our customers, our clients. You know, we don't have any money. All the money we have is theirs. And the notion that there is a pot of money somewhere in the industry that you can dig in is fanciful. The only money we have is the money of the pensioners, the money of the savers, and I always insist that policy makers keep that in mind when we make decisions thinking we're a wealthy industry. We're not. We only have the money that's given to us. And the last thing I'd say about regulation, because it concerns me, is I think that we have increasingly the enemy is hindsight, has a name, and it's called hindsight. When you're a decision maker, you make your decisions in a set of circumstances that are known. The worst thing that can happen to you is when, with hindsight, someone comes and revisits that. And we don't want hindsight to become a moral hazard for the financial services sector. So it's, I think, a common enemy and something we have to watch closely. It's very, very easy to revisit actions and decisions when everything has changed. Fourth, I will stop. This is just fourth is human capital, which has been mentioned, and I won't belabor the point, but the quality of the British institutions is well known. I mean, you have to vote with your feet. I have two sons, and I did not put them in the French system, of which I'm a product. They both went to English schools, and we're very happy with that. So it's the best compliment I can make to your education system. 2 points, two final points. One is markets have long memories and mistakes are costly. France paid for many years its inflation from the 70s with a big differential between the OATs and the bunds, and there is a cost to change, and one always has, in government in particular, to think very carefully. It's very tempting to change things all the time, but there is an opportunity cost to change. And something we absolutely keep in mind, and it's been also said by several panelists this morning, is what confidence can you have in the stability of the framework in which you're investing. And just one political comment, I really believe that countries where there is a high degree of consensus on policy have a higher chance of attracting long-term investors than countries who don't, because we all know the electoral cycle, and if you are dependent on the vagaries of the political cycle, it is very difficult to attract investment. I think the US is something that the US illustrates. Whatever the difference is between the two sides, there is a high degree of political consensus, and that type of situation gives you confidence in the future. And my final point will just be to stress all the government has done here for investment. I think a lot of good things have been done. The decrease in the corporate tax is very important, and we're very pleased to have that. The quality of the dialogue, I think, is very good. We are listened to. We both sit on the Prime Minister's Advisory Council, and we are listened to. And the final point I'll say on that is fiscal balance is very, very important, because if you're a rational investor and you look at the future, you don't want to see a government. The best predictor of future tax pressure is the fiscal balance, the fiscal condition of the country. So actually it's important to fight deficits, not just because it's a good thing, but it's also something that is confidence building, and that will encourage investors to trust that there won't be mid-course an enormous hike in taxes. So I'll stop here. I think the UK has many, many assets. Well, I was tempted not to say it, but I'll say it. I think one of the key assets the UK has is the French economic policy. But anyway, it's been working very well for her.
And I think
on that note, I will stop.
Tidjane, thank you. I think we'll probably pick up on a lot of the comments that you make in our discussion. But given, as you say, markets have long memories, but asset management is also about the future. Clearly, Boris has a very clear sense that there are many Frenchmen here in the UK, and Dominique, you're here today with us. Perhaps you might give us a slightly different perspective on what you see from the outside looking in.
Well, Katherine, thank you very much. By now, I understand that London does welcome French people very well, and I'm very happy to be here today, so thanks for inviting me. And I promise I will go home for the weekend. But I think I'll take the topic of the panel which is asset management attracting long-term investment to the UK in a very French way, which is very structured, almost Germanic. But eventually, no, I will not try. But there's eventually two very clear messages for me. The first one is that the UK, for an asset manager, is a great opportunity. So attracting asset managers to the UK should be a fairly easy job because it's the deepest pool of money in Europe. And one often talks about Europe as a united continent, and it's the second largest place for asset management in the world, but in fact, it's the UK. So it's the largest money pool. It benefits from the cluster of financial services and financial industry in this country, where you have all the banks, the issuers, the research. It's got a deep talent pool to the point where when European asset managers want to start an emerging markets focused fund, they come to the UK to find the managers for it. And it's, I think, a trend-setting place because it's so large. It's got influence through the works of consultants, global investment consultants, that are based in the UK. So attracting people like me to this country is easy. And AXA, we manage 560-odd billion euros worldwide, but about 90 billion of that is in this country, and we have about 500 people here. And as an investor, one of the big moves we made was to acquire Framlington, and it's been one of our greatest success stories, because Framlington was a very focused UK equity boutique working for retail investors. And when I look at what Framlington has become, 7 years after the acquisition, it has become a much more global company, targeting both retail and institutional investors. We have more than doubled what I call the like-for-like store sales of the original Framlington team. And we did that because we plugged what was essentially a very UK-focused business into a global distribution network. So we have raised assets in places where the company wasn't going to, like Swiss private banks, like Middle Eastern sovereign wealth funds. And that's been a great experience for us as an investor. The second message for me, and the penny dropped last night as I was preparing for this conversation, is that actually asset managers are your best sales representatives. Because when I travel the world to discuss with long-term investors in the Middle East, in Asia, what they want to hear from me is what's the view on Europe? What's the view on the UK? Why should we invest in the UK? We have lots of opportunities in Asia, in Africa, in Latin America, where the growth prospects are much higher. Why should we invest in the UK? And I think that's where the importance of asset management as an industry for the competitiveness of this country or for any country for the same purpose is critical, because we are the sales rep of the country as a destination place for investors. And that, I think, is critical. So working on the competitiveness of asset management as an industry for a country like the UK is critical, because it's going to be the pipeline to bring money here. And therefore, to echo what Tidjane was saying, making sure that the sector is properly regulated, that we regulate transparency and products more than profit and loss accounts is a critical point. So I will rest my case with those two messages: the attractiveness of asset management as a business in the UK for any asset managers in the world, and the fact that for a country like the UK, asset management is the shop window, but it's also a useful interface for a feedback loop back into the country as to what's missing or what are the issues that need to be tackled to attract money is an important factor to keep in mind.
Merci.
Merci beaucoup.
And given that you talked, Dominique, about the attractiveness factor being a deep talent pool, Davide, I know that you particularly believe that the talent pool that exists in the UK and the people that we have here, about how you make it work, that's one of the factors that you see, but perhaps you can maybe make your introductory comments.
Thank you,
Grazie.
Katherine. So First of all, investing comes from, the etymology of the word comes from investe, Latin word, that means put on a dress. So what matters is to have as many colorful dress as you can. And that's very important. So if you think why I think UK is so successful, you have one of the most important insurance company in the world expanding, an asset manager, and then you have company like mine, which are boutiques. Basically a talent pool that gets sucked in by the major institution, and after 10, 15 years of training, decides to step out of the major institution and set up their own SME. So basically, we're nothing but part of the cluster. Eventually, there are entrepreneurs within this large organization. They came here for studying, they came here because there's an open society, and they help and basically make the system more reliable and, in my view, more vibrant. Secondly, why UK? Why should you put money in the UK? Why should you invest from the UK in the rest of the world? I've been here for 18 years. I love this city and this country. And most importantly, I tell you why, because it's not just about money. It's about the brain behind the money. And here I'll just make, for example, ask yourself this question. In which of your own country you'll have the central banker that is a Canadian, the largest bank run by a Portuguese, the largest insurance company run by a Frenchman born in Africa, the stock exchange run by another Frenchman here on the first row, and the largest telecom company in the world run by an Italian. My own country has an unfortunate disadvantage that the best people we have, we tend to send them away, like Mario Draghi, the ECB, or Vittorio Colau to Vodafone. Now, this is unique to this country because basically allows capital to connect with people, and people generate ideas. And that's all what investing is about. The second point I'd like to make is do not underestimate the ideas get generated by people brainstorming. In London, thanks to what we have heard on infrastructure, and I think Boris, which is probably one of the most fabulous mayor you can have, what helps any global company to come through London. So if you sit here as an asset manager, people come to see you. You can spend more time thinking, connecting, debating, asking yourself is the right question, rather than be on a plane yourself. And you can be in here, you can invest and see, typically we see about 1,000 companies a year, and every day I see 3, 4. They come from all over the world. In the morning you have an Asian company, you can have someone from Brazil, an American. It's excellent. Basically, it's the point where people meet, and thanks to its location, to its history, everything has already been said. The last point I make, I think it's open and fair. Think about what the Prime Minister has done, David Cameron, has been the first one to say that companies like Google, Amazon, Facebook are a joke today as a global citizen. They pay less than 10% tax rate on a global basis, when global tax rate is 30%. In the UK, the three combined have paid less than £100 million over the last 7 years. And so they're the first one to say there's something that doesn't work today in global capitalism. You cannot have companies that don't pay taxes. That's not, they might hire as many lawyers and accountants they want. In reality, there's something wrong. So what I think, and this is my suggestion in how you keep London and UK competitive, at the end of the day, what an asset manager wants is to manage the money they run on behalf of pensioners, on behalf of savers, in a fair way. In a fair way means people should only pay taxes where they're resident. That's the OECD mandate. And hence, London should actually become the largest offshoring center, legal, globalized, transparent, where people pay taxes no matter where they come from. De facto, they're already doing it, because it's the most open city. In any cafe you can sit down, you'll see how many languages they're spoken. Most of them are actually resident, so there's nothing wrong with just being open and transparent about it. I think this is something the UK could work on, so that you basically close the loopholes that countries like Luxembourg, Ireland, Cayman, BVI have created. They're nothing else but legitimate way, most of the time, of investors avoiding double taxation when they want to invest globally. Because today, given the connectiveness of the world, everyone is investing globally and not locally any longer. The last point I will make, it's on balance. So openness is the first competitive advantage, of which I've already spoken about. The second is balance. Why you need balance? I think you need balance because this is a country that has realized has got it wrong. Andrew Bailey said we had 4 different banking supervision regimes. Just to give you a couple of points, the FSA has about 3,000 employees. In 2006, they had less than 81 people paid more than £100,000. So let's call it $150,000. And today, they have more than 241. So they realized they were lacking talent. Secondly, in my view, they realized that as the FSA alone has less people than the people working for the stress test in JP Morgan, just one bank alone. And as they said, it's a question of finding a balance between rule-based, principle, and here is the first country that has issued, in my view, what is the most innovative way of solving a crisis. It's to align interest of managers and all stakeholders, managers, depositors, taxpayers, bondholders, and equity holders, which is called contingent convertible. That is nothing else but a part of the capital structure senior to equity that basically says, in case we were wrong as regulators or you as managers, we have already a pre-funded rights issue. So there is no panic, nobody has to catch a plane and look for capital around the world at a stress time, which clearly wouldn't be helpful, but we can just convert you from bondholder into an equity holder. And as a result, in my view, will provide further stability to the financial system, because basically we're creating a buffer. It's what I call the second line of defense. Just in case we were wrong on the first line of defense, suddenly we build the second one. And I think it takes a lot from the public to understand, go through what you got wrong and rectify. And I think as a result shows furthermore, in my view, how the industry could evolve. Little point on this, as the FSA, in my view, was partly too politicized at the beginning of this decade, they were spending more time in chasing people like us, which have equity to assets of 1-to-1, and we deploy global capital. Most of us has all our savings invested in what we do, and very little regulating banks. So what happened? Taxpayer ended up paying £50 billion. The country got in a mess, and the reason is because the policemen were looking the wrong guys, and we were not the wrong guys, we are the right guys, and the reason because we bring diversity, because we're entrepreneurs, because we're skin of the game, and because the first one aligned not to get it wrong.
Grazie. Well, I think that all of you touched in some shape or form around the whole subject of regulation and fairness, but I think given that the asset management industry is ultimately here to provide a service to the end consumer, I think what I'd like to understand, and perhaps we can have a little bit more of a discussion here, is how do you get that balance, as you said, Davide, right, between allowing enough innovation for new products, new developments, something that the UK has been extremely good at over many, many years, whilst at the same time not depressing innovation through overly onerous regulation that perhaps may be there with good intention, but perhaps actually stifles the very heart of what makes this industry successful. So I'd be interested in your thoughts. Dominique, you look ready.
Always. No, I think the industry tends to get mired, and when I say the industry, I involve all the stakeholders to the industry, which is the operators, the regulators, governments, and potentially the consumers as well. We get mired in technical details, in so-called innovation, when what people should care about is outcome. I think as an industry, we have a very, very noble purpose and a very clear mission in life, which is that navigating financial markets is a job for professionals. You cannot expect private people in their households to be able to tell what is a reasonable investment for them for the long term, for their pensions, to fund their kids' education and stuff like that. You just cannot expect that because financial markets are just too complex and too agitated. You need professionals looking at them all the time. So as an industry, we serve a very noble purpose. That doesn't, however, require to be very sophisticated or very technologically advanced in where you put the money at work. And I think if we were focused on outcome-oriented products more than on technical things where we benchmark or focus on tracking error, active share, and all those concepts, I think everyone would do better. And allocation is certainly one of the key points going forward. Just simple allocation. And especially in those days where finding a return is hard, I think this will become even more critical.
But given that, particularly in the insurance industry, outcome is probably the most critical factor, how do you weave this into your thinking about the UK and the asset management side.
Look, I absolutely subscribe to everything Dominique said, and I would add maybe another portion of a value chain, which is distribution. Okay? Because actually, when you look at asset management, you find that a lot of the issues often originate further down the chain. That's where you have misalignment in the incentives and in the risk reward. So I think philosophically, and as an industry, we are supportive of something like RDR, and we are supportive of efforts to put more transparency down the chain, because ultimately the point of contact with the customers is rarely us, it's generally an intermediary. So ensuring that they are well incentivized, that if there are commissions, they are transparent and serve a real economic purpose, I think is very, very important. And that's an area where both regulators and governments can actually create a lot of value or avoid the destruction of a lot of value. Just to give a concrete example, if you take the life sector in the UK, it's been in negative net flows since 2005. I repeat, this is you can verify, it's an ABI statistic. The life sector in the UK has been in negative net flows since 2005 every year, i.e. there is money coming out of the sector. So I am baffled by the fact that people can publish growth statistics, new sales statistic in a market that is shrinking. Okay? That doesn't make economic sense. It is just churn. It's the same money going from company A to company B to company C to company D. If there is no new money flowing into the sector, you can't possibly grow. So, those are facts, and I think that the recent reforms will make it clearer. Well, that's what's going on, and will allow ultimately the savers, because really, as Dominique said, this is something that certainly I think keeps us all awake at night. We know there's an enormous savings gap. We know that with a demographic structure, it's very hard to plug that funding up. So really, every basis point we can scrap or produce in additional return will make a difference to people's lives in 20 or 30 years down the road. So these are important issues.
Thank you. And Davide?
If I were just to give an advice, to me will be skin of the game. So if I think today the debate among regulation, I think it's ludicrous. If you go through the analysis of what solvency do is forcing insurance companies to do, you laugh. Insurance company get asset, basically premiums, and they should invest for the next 20 years. And then someone comes in with a degree in statistics, looks at what happened the last 20 years, and simply because almost lost his job 5 years ago because he had no idea what he was doing, suddenly says that an insurance company globally cannot hold more than 3% of equity. Now think about it. How are we going to fund growth, jobs, if the longest term investor here cannot have more than 3% in equity? Just ask yourself this question. And on top, are they forcing them now to hold 50% of their assets in public debt, which yields 1%, which is basically nothing else but financial repression, central banks buying all the debt, like Bank of England is doing, the Fed, and now Bank of Japan. And I think the key reason is because people don't have enough skin in the game. Who doesn't have enough skin in the game? All of us, to be honest. So first, I start with the shareholders, so people that have the money. How many of us show up in AGM and vote what they think? We ask to make public your vote unless you don't get a dividend. So if you don't say what you think, you're not entitled to the dividend. Passive shareholders are creating a problem. Secondly, who should have skin in the game are regulators. If I were the government, I'll appoint someone of the public body here in the UK and says, your objectives, I want to have the GDP plus 2% unless you don't get a bonus next year. And I'll cut your stuff. I tell you, they'll start thinking about how to get the right objective rather than keep on writing paper. The third one, which I think is, in my view, very important, is to think about what's the implication of not having skin in the game at the executive level. Suddenly, if you only incentivize people with stock option and shares, you incentivize people to take short-term drugs. I have 4 kids. When they ask for a Coca-Cola, I know what happens. I give it to them, they're happy, and then for 2 hours, they keep on running around and screaming. So basically, I need to take a balance. What is probably more appropriate, in my view, is to incentivize them equal to the duration of the risk they take. So if you are a bank, you should be paid after 5-6 years. Let's see the loans you made, whether they were good or bad. If you are an insurance company, I think people should be incentivized over the next 20 years. Thiam should be getting his long-term compensation very deferred. It can be his own pension. But you cannot incentivize managers that take medium, long-term risk on a one-yearly paycheck. And the same should happen to asset managers. So if you invest long-term, you should have all your money invested in what you invest. In company like ours, which I think one of the reasons why London is the most prolific, let's say, center for startups, together with New York, is that people love to put their own money where their mouth is. So you run your money in the way you think. And that suddenly, I tell you, keeps you incentivized and balanced.
Well, I think that's probably a good lesson for us all, but you're not going to get paid for about 50 years. So
That's okay. He's a shareholder.
He's a shareholder.
He's a shareholder.
So I wonder whether or not it might be good to take some questions from the floor. So I'm looking around to see whether or not there are any questions. We have some microphones ready. Oh, I can see a blue sleeve about halfway down. Would you be kind and stand up? Thank you.
Good afternoon. Stephen Welson from the Business Growth Fund. I'm interested in terms of the asset allocation, how you think you can get more capital into small companies. And clearly the capital markets are incredibly efficient. The larger the company, the more their options. And when we talk about SMEs as the backbone of the economy, how can the public markets and the asset managers find an effective way, recognizing your obligations ultimately to the future pensioners, to get small amounts of money into small companies to help them grow? And I'm not talking about the private equity industry, I'm talking about exactly what you gentlemen and Katherine does.
And I think that's a fantastic point, because I think one of the things that we all know is that SMEs truly are the backbone of the country and of the growth. And I think many of them say that it's incredibly difficult to get funding from the banks. So Davide, I'm going to hand that to you.
That's actually one of the most important questions today in Europe. Both the liability, lending, banks being able to lend, and investing in equity. So think about it today, what we're doing. From the Solvency II perspective, insurance company cannot invest up to a certain amount in BBB, basically investment grade. Now, I can tell you, no small company can actually have a rating, and most of them will probably be non-investment grade. So suddenly, you cannot have long-term equity. People on the equity side cannot invest in it because they're not listed, and the banks get penalized because suddenly they don't have collateral and they don't have a rating agency. So my first big problem is rating agency. Rating agency have been allowed by the regulator that basically wants to cover the butt. So this is not our problem, it's someone else that gave a rating. Well, sorry, we need to basically cut this loophole. As a result, I think people should be allowed to give their own rating internally, see an SME, and decide what's the probability, what's the rating on this SME. I rate it myself, and I'll be able to lend or to invest. So the only way you put capital into this sector is to cut off basically the strings attached to being regulated, either on the equity side or on the insurance side. If you don't do it, it becomes legal. If it becomes legal, we're not allowed, and as a result, we won't do it. It's no more complex than this.
I can just add a word. We have created at M&G a UK company financing fund that has now lent about £900 million. And in total, we have picked up about £10.8 billion of loans in situations where banks have retrenched. So as a company, we believe there is a big opportunity, and we are doing really everything we can to plug that hole, because yes, that's the only way to create jobs and to have growth in the economy, which ultimately is good for everybody. And I think at the ABI level, you've got other companies like LNG and others trying to do the same thing. It's a real issue.
Thank you. Are there any other questions? No? Well, I think one of the next things that I see, we have a little bit more time left, but one of the second things that I really wanted to get into conversation about was what's the big opportunity that you see looking forward for the asset management industry? I think we've talked a lot about the factors that make this country incredibly competitive and attractive, but I think that hopefully the audience is either going to stay here or go back home, and I think it would be useful to have a sense of what is the big theme opportunity that you see that is either playing out in your own world or that you're investing in that you believe can make a tangible difference to how this sector does and flourishes for the next few years. So Davide, I'm maybe going to start with you.
I think for us, which we invest globally in financials, so banks, insurance, real, exchanges, anything that is in the infrastructure of the asset management industry, the biggest theme, in my view, will come from actually contingent convertible. So basically, is what the UK has created is this instrument between equity and senior. And so even though the people representing number 10 might not be very happy, I will say that before you buy any British bank's equity, you first invest in their contingent convertible. And the reason is because you're guaranteed to get paid 7-8% for the foreseeable future as long as equity is any value. And so clearly that's a better proposition than just risking your shares on the equity. Secondly, I think this will be a trend going forward because as the crisis has demonstrated, when you tend to regulate, you basically rely on maths and what has happened over the last 20 years. As the world is always different because you never know the future by definition, you need to create a buffer just in case you're wrong on your assumption. And as people make millions of assumptions, as a result, in reality, we never know. So we've been regulating the industry globally in financials to have 2% of equity as percentage of total assets. We're now at 10, maybe more or less, we don't know. I think by having an extra 10 of buffer, it's a good way of starting, just in case you're wrong. And I think this will be a good way also in insurance for the most importantly diversified insurance company. As the system will be more capitalized, then people will feel more comfortable to lend because they know in case one of their assumptions was wrong, they can sleep at night.
Thank you. Dominique, what's the big opportunity that you see?
I think we can talk about two big opportunities, but the point I'd like to make is that the industry's interests are aligned with the countries and the economies at large interests, because the function of this industry is to allocate capital. This industry has got no capital of its own, none. It's the point that Tidjane made earlier. We are just fiduciaries of our clients' money. To attract money from the clients, we need a story to tell. And the example I gave earlier on what you tell a Middle Eastern sovereign wealth funds on why invest in the UK, we need a story to tell. I think this country sets itself apart on many dimensions, and there's been many comments made. One of the key dimensions it sets itself apart is innovation. I think the UK is the 7th biggest contributors to patents worldwide. And I think the concept of the patent box is a very creative and productive idea. And there are two fields where patents or new ideas are necessary. There's what I call green technologies, which is how do we become, as a world, more efficient in how we consume our resources. That's a key one. The second one is that we are all going to live much longer than what we expect. Maybe much longer than what we hope, but we're all going to live much longer than what we expect, which means that there is something about the silver economy that needs to be worked out. How do we make use of the new resource that we have, which is in fact the fact that people live much longer and have effectively third and fourth lives once they have retired? How do we put those resources to work, and what do we deliver to those people to effectively enhance their quality of lives? And I think if we innovate on green technologies, on the silver economy, then as an industry, we have a story to tell to fuel the pipeline between investors and issuers or companies that need money.
Because as you say, that's the critical link that we've got to get right.
And that's our function. The function of the asset management business is to be the pipeline between issuers and investors. But for the pipeline to come here rather than stay in China or in Indonesia or Latin America, we have to have a story to tell. As I said earlier, we are the best sales representatives of an economy.
And in terms of the innovation side, I think we've heard throughout today that we have a fantastic resource here in the UK in terms of the universities, the colleges, the schools, and it attracts people from all over the world. So I think we have a secret ingredient. We now just need to bake it into a wonderful cake. So Tidjane, I know you can cook. So tell us about your opportunity.
You probably know my answer because I talk about it all the time. So it's infrastructure, and it won't be a surprise because I really think if there is a silver bullet, that's it. For that aging, that saving gap that we have, unless you create actual, real economic value, we're not going to make it. The only answer to that is growth. And the best and the most effective way to kickstart growth is to invest in infrastructure. Infrastructure is the foundation that allows economic activity to flourish. You need roads, you need energy, you need telecommunications. Someone was telling me recently, Nigeria had 300,000 mobile phones a few years ago. They now have 100 million. Right? Think about the economic connectivity that takes place behind that. So that is totally obvious in the emerging world, but I think it's also true in in the developed world, where all the Victorian investment that you saw in the second half of the 19th century across the West is completely decaying, absolutely needs to be replaced. And that's an enormous opportunity. And if I may maybe not be politically correct, but the other thing I like about infrastructure is that it creates jobs, and an economy needs to create jobs for everybody, not just people who graduate from Oxford or Cambridge. You know, it's good to be able to pick up a shovel and get a job and be paid and go do something that is also productive for the economy. And I will add, sorry, I'm really passionate about this, but I will add that all those companies we're investing in Indonesia, in Malaysia, will make more money when the roads are better. They'll make more money when the telecoms in Malaysia are better. So there is a virtuous circle there where all the factors work positively, more jobs, more growth, more tax revenue for the government, better climate to invest in long term. And this is the way it goes. So I am passionate about it. We're working very hard to be able to fund more infrastructure investment in the UK, very closely with the government, and also abroad, because I think that's, unless growth is higher globally, we are headed towards, just look at the result of every election in Europe, and you'll see what you need to worry about.
But I think then that begs the question, is it happening fast enough? Because, we have somewhat of an economic malaise on a global basis. There are pockets of growth, but I think, we need to have a bit of a sort of foot flat on the floor. So
it's vital. It's vital. For the economy, for the democracy, for the world we live in, I think it's vital.
So I think that, there are huge opportunities out there in the asset management industry, and I think, from my point of view, I think one of the big opportunities that I see is that it would be a fantastic legacy for our generation of chief executives if we were able to do the best that we can for our industry, such that we can rebuild trust that has been so badly lost. We heard a lot in some of the panels earlier on about this desperate need to fix a broken system. And I think that given that asset management is all about looking after someone else's money on a long-term basis, if we can do that, then I think that will be a fantastic legacy. And I think if we can turn words into actions, then I think we and the generation that follow us will have done a good job. So I think with that, I'm going to thank my wonderful panel, and thank you all very much indeed.